In this module, we're going to look at sale transactions. So again, when we sell merchandise or sell inventory to our customers, we're going to need to do we're going to have to do two things. The first is we're going to want to recognize our revenue and recognize that we now have received cash from a customer, or we have money owing to us from a customer in the form of an account receivable. So we want to do that. The other thing we have to recognize is the fact that we no longer have that inventory for sale. And so we need to record that we've reduced our inventory. We also need to record the cost of that inventory. So we need to sort of align the revenue that we've received with an expense that was incurred to receive that revenue. And so when we think about inventory, in order for us to make some money, we have inherent costs associated with it, which is the cost of the inventory itself. So for example, if we have a blender that we sell to a customer for $50 and it cost us $10, that cost of the blender was incurred in the sole purpose of generating revenue from resale. And so we need to, again, as the matching principle tells us, we need to ensure that as we recognize the revenue, all applicable expenses that were incurred to generate that revenue are recorded in the same period. And so we need to create two different transactions. Okay. Other things to remember in the sales of merchandise transactions, that any sales taxes that we collect are separated from revenue. Again, the sales taxes aren't for us to keep. We're collecting them on behalf of the government, and then we'll have to resubmit them out later. So we'll talk about that. And again, depending whether we have FOB destination or shipping point, again, it's sort of the opposite rule to when we're purchasing inventory, in that if we have FOB destination, now we have to record the cost of freight. This time it's going to be set as an expense. There's also times that we may have sales returns and allowances. So again, we have customers who are returning goods that are either defective or not quite what they asked of, and whether we decide to return that inventory or provide a discount or an allowance to our customers. Again, all of those sales returns and allowances, we keep track of them separately, and they act to sort of offset some of our revenues. But we want to keep those separate because it gives the readers of financial statements a bit more information. So we could have net sales of $1 million, but that could have meant that we had $2 million of sales and $1 million of returns. And our readers of financial statements might want to know that breakdown so that they can make decisions about the quality of work that we're doing and things like that. And so we keep those sales returns and allowances in a separate account called sales returns and allowances. And we'll reduce our sales by that amount in our statement, in our income statement. Also, we may have sales discounts. So again, we could provide discounts to customers based again on either volume or associations they may be part of, or based on repayment terms of amounts that they owe us. So again, we could provide terms of credit that would say if they paid us within 15 days, they receive a discount. And so again, we want to keep those discounts separated, again, to provide the most information for decision makers both inside and outside of the organization. So typically when we look at sales transactions, we have our overall sales. We're going to subtract our sales returns and allowances, subtract our sales discounts, and that's going to give us what we call our net sales. So let's take a look at some of the transactions that we see on the sales end. So first, when we sell merchandise to a customer, we have either we receive cash or an accounts receivable. So again, that's the first part. We have now an asset, and we record our revenue. So we record our sales. So this is transaction number one. The second piece is we need to then reduce our inventory. We no longer have those goods available for sale, and so we need to credit our merchandise inventory account, get rid of the goods off of our books, and we need to recognize the cost of those goods. So this is what we call cost of goods sold, and this is an expense account. Okay, treated the same way as an expense. So that's the cost of the inventory that we sold. So we need to recognize that expense in the same period that we recognize our revenue. So these two go together, our sales and our cost of goods sold. Okay, if we allow a customer to return goods, or if we provide them an allowance, again, we're going to set up our sales returns and allowances. So again, we'll debit that. It's a contra sales account, so it has a different balance than our sales. So sales would typically have a credit balance. A contra account simply means that we have the opposite normal balance. And we'll either pay them cash as sort of if they return the merchandise, or we'll reduce the amount that they owe us in an accounts receivable. And so we want to reduce those assets in this case. Okay. The other thing that we have to think about is, is the inventory still good? Can we sell it to another customer? And so if we can sell it to another customer, we have to put it back into our inventory account, put it back on the shelf. And so we need to debit our merchandise inventory to put it back on the shelf, recognize that we have those goods back on the shelf. And we need to reverse the expense that we would have utilized. So again, when we make the sale, we recognize an expense called cost of goods sold. And so if we have something that's been returned, we also want to reverse that expense because we reverse the revenues. Okay. So next is if we have to pay the freight costs on FOB destination. So simply freight out, we could also call this delivery expense. So again, it's just an expense account. We debit it and we'll credit cash. We receive payments from customers within a discount period. Again, if we provide a discount to customers that owe us funds, if they pay us within 5, 10, 15, 20, 30 days, whatever our credit terms are, again, we're going to receive some cash. It's not going to be the full amount that the customer owes us, but the customer no longer owes us money, so we're going to remove the entire accounts receivable. They've given us some cash. We've accepted that because they paid us early, they don't have to pay us quite as much, but they don't owe us the money anymore. So we need to reverse the accounts receivable for the full amount, receive the cash that we get, and the difference would be our sales discounts. And last but not least, if we receive payment after the discount period, again, quite simply, receive cash and remove our accounts receivable. Okay, so again, take this opportunity to work through some of the practice problems and the self-assessment problems, and we'll work through some of these journal entries and sales transactions in our weekly tutorial. Thanks so much, and hope you're having a great day.